Ladies and gentlemen, good day and welcome to ArisInfra Solutions Limited Q1 FY26 conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Mamta Samath. Thank you and over to you, ma'am.
Thank you, Bhavya. Good afternoon, everyone, and welcome to the Q1 FY26 earnings call of ArisInfra Solutions Limited. Today we have with us Mr. Ronak Mohria, Chairman and Managing Director, Mr. Srinivasan Gopalan, Chief Executive Officer, and Mr. Bhavik Khara, Whole-Time Director and Chief Financial Officer, and the Adfactors IR team. We will begin the call with the opening remarks from the management, after which we will have the forum open for the interactive Q&A session. I must remind you that this conference call may include forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. The statements are not a guarantee of future performance and involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Srinivasan Gopalan, Chief Executive Officer of ArisInfra Solutions Limited, for opening remarks. Thank you and over to you, sir.
Good afternoon, ladies and gentlemen. Welcome to our Q1 2026 results. We are very happy to announce the results today, and even before I start my speech, I want all of you to note 4 things which I am personally very proud of and very happy about. That there are 4 things that we have achieved for the first time in this quarter. One is our EBITDA has gone past 9% for the first time. We have clocked around 9.2%. We have become completely debt-free by way of net debt is 0 as of today. Our working capital number of days has gone below 100. We are at 97 days today. And the Q1 results, we have shown a net profit of 5.1 crores, which is almost 85% of the entire year last year that we clocked. Having said that, let me now start the results speech. We are pleased to report a solid start for financial year 2026. Q1 reflects the strength of the model we have built, one that is scaling with clarity, control, and discipline. It's important to highlight that this performance was delivered without any benefit from our IPO proceeds, except the debt repayment which I mentioned to you earlier, which we were available only at the very end of the quarter. The impact of that capital in terms of growth, profitability, and working capital optimization will begin to reflect from Q2 onwards. Very important to note this. Our supply services tech model is gaining strong industry response. In a sector that's traditionally fragmented and execution heavy, what defines us is our ability to bring together reliable supply, project-aligned services, and smart back-end technology into a single integrated operating model that helps construction happen faster and with very few dependencies. This is not just showing up in numbers, it is showing up in relationships as well. From earlier MOUs and order wins with Vadhva, Transcon, and Village Wave to our most recent addition of AVS, which we did yesterday, the momentum is clear. Developers are looking for long-term, dependable partners who can simplify execution at scale. We believe ArisInfra is uniquely positioned not just to grow, but to do so with capital efficiency, margin visibility, and return discipline. There are 3 strategic pillars driving scalable and profitable growth, each of which plays a central role in making this business structurally stronger and financially more rewarding. The first one is that strong demand-supply engine that generates returns at scale. At the heart of our model is the ability to efficiently match demand with secured supply, not just once, but consistently across geographies and volumes. You must have also heard our announcement about a 300 crore facility that we have been able to bag with the House of W. We have built an organized network with long-term visibility on both sides, securing capacities through strategic deposits and serving institutional customers with predictable repeat demand. This network effect ensures that as volumes grow, we just don't grow revenue. We improve margins reduce volatility, and strengthen our position in the ecosystem. This is exceedingly important for us. The second important point is the shift towards smarter working capital management. Working capital management is the core of our business. In our earlier years, in the last 4 years prior to the IPO, we funded working capital through internal accruals and equity, allowing us to scale quickly without external pressure. But now we are moving into a more strategic approach. We have initiated the process of securing supply chain financing facilities, enabling us to extend vendor payments without disrupting supply or using equity. At the same time, we are scaling invoice discounting with institutional customers, unlocking receivable earlier and accelerating the cash cycle. Close to 40 to 45% of our sales are mainly to these large clients where bill discounting is a given. Together, these steps reduce working capital pressure, unlock more capital for growth, and improve overall return on capital employed. The third pillar, as I mentioned, is the asset-light model that preserves flexibility and reduces risk. We have made a conscious decision to stay asset-light in the near term, scaling through strategic partnerships and contract manufacturing instead of investing ourselves in capex-heavy assets. This approach gives us all the benefits of a manufacturer, including reserved capacity, cost control, and supply security without the operational risks of owning and running assets. The biggest of these risks isn't just capital outlay, it's operational bandwidth. Owning and operating plants and managing full-scale production can divert focus from execution. By staying asset-light, we preserve that focus and double down on what truly sets us apart, our integrated supply service model. This model allows us to move beyond material delivery into project-based services that generate stronger returns, enable deeper customer integration, and drive structural margin improvement. In many ways, it's our asset-light approach that makes this high return integration possible. Coming on to the financials, we have a sustained momentum across materials and services. The total income for the quarter stood at 216 crores, up 11% year-on-year. While Q1 typically sees seasonal moderation versus Q4, our volumes remain steady, supported by consistent demand from institutional customers and a robust supply backbone strengthened by long-term vendor partnerships. Coming on to the profitability. Services-driven margin accretion. EBITDA stood at 19.5 crores, up 13% year-on-year and 77% if I compare it with the last quarter. Driven by better contribution margins, disciplined cost structures, and scale efficiencies. A key driver of this important improvement is our services vertical, which continues to grow in both relevance and profitability. It helps us move beyond transactional supply into higher margin, longer cycle project involvement, which deepens customer engagement and improves commercial outcomes. EBITDA margins, as I mentioned to you, went beyond 9% to 9.2%, reflecting operational leverage and the structural advantage of our integration model. Coming on to the bottom line. PAT for the quarter stood at 5.11 crores after absorbing an exceptional IPO-related expense of 2.5. So ideally, it should have been close to 8 crores. Adjusted for this, PAT stood at 8 crore compared to 6.5 crores in Q1 last year and a 52 lakhs of loss in Q4 2025. This reflects a clear return to consistent, sustainable profitability driven by margin expansion, growing services contribution, and improved capital efficiency. At an annualized rate, this translates to 30-32 crore of PAT, even before factoring in the benefit of interest savings and IPO-fueled growth expected in the coming quarters. With proceeds from the IPO and disciplined capital allocation, we are now nearly debt-free, as I mentioned at the beginning of this speech. This enhances our financial flexibility and strengthens our ability to scale efficiently across core markets. Coming on to a very important subject, which is the working capital. Something which everyone thought is the pressure point, we have converted that into a strategic advantage. Working capital has historically been our biggest operational risk, and it continues to be our key focus. We are addressing this head-on with a structural shift in how we fund growth. On payables, we have initiated the process of securing supply chain financing limits, allowing us to extend vendor payment terms without impacting material flow or straining vendor relationships or margins. This allows us to free capital with preserving trust and continuity on the supply side. On the receivable side, we are scaling up invoice discounting, especially with institutional customers. This helps accelerate cash flow without relying solely on payment cycles. Looking ahead, we expect continued improvement in receivables through a multiple pronged strategy, increasing wallet share with better rated customers, moving to a more project-based engagement model that ensures better payment discipline, and actively diversifying the long tail of buyers to reduce concentration risk and improve collection cycle across the board. Over the last 12 months, we have brought our net working capital cycle down from an approximately 120 days to a 97 days as of Q1. If you remember in our past investor call, we had mentioned that we would be at an 85 to 90 in 12 to 18 months. We are very happy to mention that we are at the 90s already in the Q1. From 120 days in December to 110 in March and now to 97, a level that once seemed distant. This progress reflects deliberate structural actions. While this is an ongoing journey, we remain focused and confident of bringing it further down to 85 to 90 days range over the coming quarters and sustaining it as we scale. This isn't just operational optimization. It's a fundamental shift that improves return on capital and supports sustainable capital light growth. Reinvestment of cash flow for scalable growth. As a working capital-led business, we actively reinvest cash into operations, primarily through trade deposits, receivables, and project-linked supply arrangements to drive growth, secure supply, and deepen customer relationships. While this can occasionally result in negative operating cash flow, it does not mean that we are burning cash. Rather, it reflects our disciplined approach to deploying capital in areas that generate high returns and generate structural advantages, such as securing vendor capacity, expanding services, or increasing wallet share from institutional buyers. With strong controls, smarter capital structures, and improving working capital efficiency, we expect cash conversion into structurally improve without compromising on growth. In Q1, our receivable collections remained strong, with vendor payments made in line with operating volumes, indicating a steady and disciplined cash cycle. This flow validates our belief that tighter working capital control can drive sustained growth without putting strain on liquidity. We are built for construction, design, and designed for returns. ArisInfra is built for the real needs for construction, where timelines are critical, quality cannot be compromised, and execution makes all the difference. What sets us apart is not just what we supply material or provide services. It's that we do both in a structured, dependable, and technology-enabled way. As we look ahead, our focus remains clear. Grow with control, deepen our customer and vendor network, and operate with sharp capital discipline. So this becomes not just a high-growth business, but a high-return business. Thank you for your continued trust and support. We are now happy to answer any questions that you have. As mentioned earlier, I have my Chairman and Managing Director Ronak and Bhavik, who is our CFO and whole-time director. We are happy to answer your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Shaurya Yadav from Pinpoint X Capital. Please go ahead.
Hello, am I audible?
Yes, you are.
Yeah. So, thanks for the opportunity. Sir, I have a couple of questions. The first one is that our last year Q1 PAT was 6 crores, which is exactly equal to FY25 PAT. So, sir, which means net for remaining 9 months we have incurred losses. And similarly, sir, this year we have posted PAT of 5 crores in Q1. So, I just want to understand what exactly had happened in Q1 FY25 that we have reported PAT, and for the remaining years we have incurred net losses. what was the reason for higher growth in Q1 FY25 and like going ahead in FY26? Can we see any quarterly losses like we have seen in FY25 for remaining 9 months?
Yeah. So, thanks for that, Shaurya. Let me put the number more into perspective with respect to the quarter-on-quarter comparison, year-on-year. 5.1 was recorded for this quarter, but it was after an IPO expense, which is one of the last expenses that we will record with relation to IPO, which was about 2.8 crore. If you factor in that, we are at about 7.4 to maybe about 8 crore of PAT in this quarter, which is in fact our highest ever PAT margin, and is in fact about 15% growth year-on-year when you compare the 6 crore of profit in that quarter. The debt levels were different. In quarter one FY25, the debt was smaller. We had more debt in quarter one also, where the interest cost was approximately 2.5 crore higher. And that's predominantly why, even with a higher EBITDA margin, we have grown slightly lesser in terms of PAT, with just about 15% growth. With respect to the financial year FY25, we recorded a PAT in the first quarter, but we had the IPO-related expenses again in the same financial year, which kind of impacted the entire year's profitability. If I adjust all of those costs, we would be somewhere around 12 to 13 crore of profit before tax in FY25. This is something that we had obviously mentioned in our last earnings call as well. We had to absorb those costs in our P&L, and that is why the numbers were, reported, at about 6 crore of PAT the entire.
Yes, sir. And sir, going at in FY26, so there will be no quarterly loss that we have reported in FY25.
No, FY26, I mean, if I were to concentrate on FY26 right now, we are at about a 7.5 crore of PAT adjusted to that IPO expense. So we are already at an annualized PAT of about 30 plus crores. And we haven't used even a rupee from the IPO proceeds for the operations. We have just repaid the debt as on 30th June. So, and obviously by repaying the debt, there will be significant interest cost savings as well. So an annualized PAT of about 30 crores already there, with interest costs, reducing and more of the EBITDA flowing into the PAT, and 3 quarters to perform with the IPO proceeds, we expect the PAT for this year to be significantly higher.
Okay, sir. So is it fair to assume that the current operating margin will remain going ahead in FY26 because of increasing contribution from RMC and service-led business, which I think is a higher margin business?
Absolutely, yes. In fact, it's not just about the numbers, it's where the margins come from. You're absolutely right about the growing services business. And this is really backed by the recent announcements that we made, close to about 450 crores of contracts and order wins that we have announced. And the contract manufacturing, which has been, the focus ever since we started that business about 2 years back. We've been growing in that segment, and we feel that it does not just give us additional margins. It gives us supply security, it gives us quality control, it gives us cost discipline as well, where if we were to look at fulfilling the higher demand of large-scale infra projects or real estate developers, it is very important to secure your supply so as to fulfill that kind of demand. So contract manufacturing, growing services, all is going to be our focus, and we feel that's the reason why we'll be able to sustain this EBITDA margin going further.
Sir, just a follow-up on that, as you said that there will be no quarterly loss and going ahead, margin will remain in the range of 9 or 9.5, which is the current rate. And also interest cost is coming down due to debt repayment. So is it fair to assume that our PAT margin will be in the range of 5.5 or 6%?
Well, I've given a reference of the analyzed PAT for this year. We are yet to deploy IPO proceeds, which will start from this quarter, the September quarter. We have 3 quarters to perform. At the current rate, if you look at our PAT, it's about 2.5, which will kind of increase because of this interest cost savings. So, yeah, fair to assume that we will be somewhere around maybe about 4 to 6% of PAT, but that's just the future guidance that we can give. I think it's more important to understand that the industry that we operate in right now, it's one of the largest sectors in India, which is least disrupted, and it gives us the potential to actually grow with such high margins, and that's what we would like to focus on.
Okay, sir. Thank you, sir. Understood.
Thank you. The next question is from the line of Vishwinder Singh from Prudent Equity. Please go ahead.
Hello, sir. I had a few questions. So first of all, can you share what is the current monthly rolling order run rate, and how are you planning to increase this?
Yes. As mentioned in the previous earnings call also, our rolling demand is close to about 60 to 70 crores a month. We have initiated deploying the IPO proceeds from this month itself, and the guidance that I given before was to reach about a rolling demand of around 90 to 100 crores on a monthly basis in the coming few months. So that is where we are headed, and we are very confident because we are going to do this through two things. One is increasing the wallet share with existing customers and onboarding a few new customers as well. And the project-based order book that we have recently onboarded will only add to this rolling demand as we grow.
Okay, noted. And secondly, I wanted to ask, how do you see the revenue profile for this year and next year for our subsidiary BuildMax that we are investing after our IPO?
In BuildMax, we have partnered for mainly aggregates, stone aggregates. I think the current the capacity that we were working on previously till about March or maybe about June was in the range of about 1.5 lakh metric tons a month. We have already initiated capacity expansion there, and I think we'll be clocking 2.5 to maybe 3 lakh tons as we move forward in the coming months. So the investments are in the right direction. The category is very exciting. It's high margin. We have complete control over all these capacities, and we are looking to deliver all the large infra projects down south. So yes, I mean, we'll be looking at increasing the capacity. We've already initiated the process, and we will see good progress in the subsidiaries as well.
So do you have an internal ballpark number for the revenue target of the subsidiary for this year and next year?
I would say based on the capacity that I'm talking about, it should be somewhere around July would be close to about 8 to 10 crore of monthly business. So an annualized business of about 120 crores. We will see good growth also in terms of the next 3 quarters. So, that's the kind of number and growth that we're talking about.
Okay, noted. And I wanted to ask, we have reported strong increase in our margins. So what has been a major trigger behind it?
With respect to margins in our business, it's mainly because of our model, which is a combination of supply, services, and technology. All these three things come together, and that is why the consolidated profit has seen a significant increase in the last few months. What I mean by that is, when it comes to supply, it's not just about buying and selling materials. It's about building a very solid supply backbone and forming long-term partnerships and securing capacities so as to secure supply as well as add margins, get volume discounts. With respect to services, we go beyond supply as well. When it comes to real estate developers, today developers need three things in fact, to ensure that execution and ultimate handover is in place. One is materials, second is execution or management, and third is inventory marketing. We offer everything. We are present at every part of the supply chain, most other people or companies are either offering a couple of materials or maybe just present across one aspect of this value chain, which is material supply. And to manage all of this at the back end, we have built in-house technology, which actually absorbs the entire operational bandwidth. This is the reason why we have seen tremendous improvement in margins, and we feel that we have built a very sustainable foundation to not just grow, but to sustain these margins as we scale.
Okay, noted. Lastly, I wanted to ask, after Q4, in Q1, we have gone from 2,700 to 28, somewhere around 2,800 customers, and we have also increased our PIN codes that we serve. So what would be the strategy going forward to increase both our customer count and total PIN codes served?
To be honest, these are outcomes of our reach across the country, and the fact that we can onboard new customers on a quarterly basis. But our focus, to be honest, is on the institutional demand that we can grow, increase wallet share with the existing customers as well. So it's not a very conscious decision. It does not really operate like a B2C business where more and more PIN codes or more and more customers are the only focus. It's just about working on diversity as we grow, where we will look to do both, not just onboard new customers.
Okay, noted. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Kaushal Sharma from Equinox Capital Ventures Private Limited. Please go ahead.
Hi, sir. Very good afternoon.
Hi.
Yeah. So my question is on your guidance. Like in the last call, you said that we will grow around 30 to 40% over the next 2 years. Now we have gone around sales. So are we in line with our target? And my working capital side, sir, could you please receivables as on this quarter
Sorry to
end?
interrupt, Kaushal. Sorry to interrupt, Kaushal. Your audio quality is not clear.
Hello? Now is it? Hello?
No, it's still breaking.
Cutting out a little bit.
Still breaking. Sorry, sir. Still breaking.
Hello? Now is it fine,
Yes.
sir?
Yes.
No, sir.
Yeah,
It's
better.
Yeah.
A little bit.
So, sir, my question is on your revenue guidance that in the last call you said that we will grow with the 30 to 40% and currently we are growing around 11%. So are we in line with our target? And my second question on the working capital side, sir, what is our receivable in value as of today and the payables?
Yes. So, the 11% growth that you're talking about is really, basically compared to the quarter, year-on-year quarter, the growth is about 11%. What we meant was because of the IPO proceeds coming in, debt repayment and, unlocking more capital for growth, we'll be able to achieve, the guidance that we've given, which is about 30 to 40% year-on-year growth. That's how we'll achieve it. With respect to trade receivables, we are at about
We are at about 130 days in terms of days and about 350 to 360 crores of receivables. In terms of payables, we are at about 34 days and about 130 crores of payables. So our net working capital comes to about 96 to 97 days.
So receivables in value around 350 crores, right, sir?
Yes.
And payables 130 crores.
Yeah, so that's how we've improved from 120 to 97.
Okay, sir. Okay. Thank you, sir.
Yes.
Thank you. The next question is from the line of Deepak Poddar from Shefar Capital. Please go ahead.
Hello? Hello, am I
Hi.
audible? Yeah. Thank you very
You
much,
are.
sir, for the opportunity. So just wanted to understand, for next 2-3 years, we had been saying about 40-50% growth or 30-40% growth?
We will be somewhere, range around 40%, to be honest. That is something that we are constantly targeting. It also comes from the fact that we operate in an industry which offers that kind of growth potential. It's not really about growing the revenue. It's really about sustaining the EBITDA margins and the PAT margins, and also keeping the working capital cycle under check. So it's not really about a hard revenue number. We will be looking at a growth of around 40%, up and down. But more importantly, the focus is on, the EBITDA margins, the PAT margins, and obviously the working capital cycle.
Okay. And since we have grown only by 11%, now the IPO proceeds money will also kind of kick in. So we'll start seeing growth from this second quarter itself. Because in the first quarter the growth was not there, right?
Absolutely. The first quarter we didn't utilize even a rupee from the IPO proceeds. We've already started deploying the IPO proceeds. We had a very good visible order book. That's what we've been doing, ever since July started. So yes, September quarter is going to be the first quarter with, visible growth, not just in terms of revenue, but in terms of margin and PAT expansion as well. In absolute terms.
And growth as well as margin expansion.
Yeah, in absolute terms. Not to say that obviously, the 9% is something that we will sustain maybe, but in terms of absolute numbers operating, let's say we clocked about 19.5 crore in the first quarter, we will see a visible improvement in second quarter in terms of absolute numbers.
In absolute terms, percentage may vary, but in absolute, you are saying it might.
Yes.
Okay.
We'll try to sustain it.
Yeah, I got it. And we had around 2 crores of minority interest. So what is that on account of?
So that's basically the subsidiary, other comprehensive income. There's a subsidiary ka portion. That's what it's for.
So this is what that RE subsidiary? Union.
So we have about 6 subsidiaries. So it's allocated in terms of the comprehensive income. The allocation to the subsidiary is about 2.5 crores.
Okay, so that will continue. For the entire year, you expect such quarterly.
It's going to be in check with the growth of the parent company along with the subsidiaries. We'll be in tandem with that.
It will remain tandem with that. Okay, okay. Fair enough. And in terms of interest also, I think we have become debt free that you mentioned. So in terms of interest cost, how should we see that reduction? I mean, this quarter it was 11 crores, around close to 12 crores a quarter. So going forward, what sort of interest cost on quarterly basis we can expect?
So on a quarterly basis, the primarily interest will be by way of bill discounting, and that should be between 1.5 to 2 crores a quarter. So that should be the range where we should have the interest cost at.
So in rupees crores, is it possible to, mention in rupees crores, how much would that we expect?
Yeah. So just to kind of put that, just to understand how it will kind of go down, we repaid a debt close to about 200 crores and another 30-40 crores. So the interest that was connected, that was allocated, this kind of debt was close to about 30 to 35 crores. And that is something that we will see reducing in the coming quarters, with maybe a little bit of an increase in bill discounting or invoice discounting or supply chain financing interest. Our net outflow in quarter one was about 9.5 crores. We expect this to come down by more than maybe 70-75% in the coming quarters. So, that's probably the guidance that I can give you today.
So reduced by 70 to 75%. I mean, if I have to see, let's say 40 crores on an annual basis, 45 crores. So if it has to reduce by 70 cents, so 15 crores debt interest cost.
41 is not the net interest outflow. If you look at the net, it's reduce the operating income from interest. The net outflow was about 36, and that's what we intend to reduce by about, let's say, 70% as we go forward. That's the
net interest outflow to reduce by about.
Yes.
After factoring in your other income, right?
Right.
Okay. And just one last thing. When we say a 4 to 6% kind of a PAT margin, so we have factored in minority interest, or with, it's excluding minority interest or including?
Excluding the minority interest.
So excluding, we have subtracted after that, we are getting that 4 to 6% of PAT margin.
So 4 to 6% will be for the entire thing, and after that we will be reducing the minority interest.
It's before minority. Okay. It's before minority. That's very clear. And in terms of leverage, if you have to see, because we have been growing, we are looking to grow about 40% CAGR over next 2-3 years. So how should one look at margins front overall? What sort of leverage advantage we can? This year you're targeting 4 to 6%, but if you have to see over next 3 years, any kind of aspiration we have on the margin front? How should one look at?
Not in terms of numbers, I can give you more over there, but what I can, it's basically dependent on that we have is supported by a very complex backend technology. And as we scale, what we expect in our business, because it's execution heavy, it generally requires a very large workforce to handle and manage and execute.
No, come again. Can you just repeat, sir? I didn't get what you're saying.
Yeah. So in terms of our model, it's important to understand what we are building with respect to, the supply services and the backend technology.
Right.
As we scale in this execution heavy business, generally we would require a very large workforce to handle the backend operations. And because we have built, in-house technology to kind of absorb all of the operational bandwidth, we will see the operating leverage kick in as we scale, and we're ready for that. So it's how we work, how we operate. As a company, it's where we will be able to sustain and maybe have some bit of improvement in our operating margins as well as we scale.
Yeah, that's what I was trying to understand. Because your operating leverage will kick in, so the EBITDA margin, which is currently, let's say, 9.2%, including other income, right? So how should one look at, what sort of accretion we can see there? Can it be 100-200 basis point over the next 2 years or higher than that? Some understanding on that would be very helpful, sir. Yeah.
I would answer the other way, where let's say today our entire capex maybe is as a percent of revenue somewhere around maybe 4.5 to maybe 6%. We will definitely see an improvement of maybe about 1.5 to 2% as we grow in the next maybe 18 to 24 months.
1.5 to 2% margin improvement over next 18 to 24 months.
Yes. What we are seeing is as we scale, we are generating more and more revenue with the same kind of workforce or keeping the costs under control. And this is something that we are very conscious about. We want to maintain the cost discipline that we have maintained in the last few months, and we expect this to be maintained in the coming quarter.
Fair. That's very clear, sir, and very helpful also. I mean, that would be it from my side, and all the very best to you. Thank you so much.
Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to two per participant. Should you have a follow-up question, we would request you to rejoin the queue. The next question is from the line of Kapil Ahuja from Equinox Capital Ventures Private Limited. Please go ahead.
Yeah. Hi, sir. Congratulations for good numbers. My question is regarding the receivables. You just said that the receivables as on June 30 was 360 crore, 360.
316.
360.
Yes.
360. And in March 25, the receivables were 327 crore. Am I right?
Yes.
So for top line growth of 11%, you have the receivable growth is also of 11% only. And for this 360 crore, what is the aging of this? More than 6 months and less than 6 months?
So as of now, more than 6 months would be approximately 65 to 70 crores.
65 to 70 crores. Okay. So, what's the reason for so big high receivable days, and can we reduce them, or we can increase the payable days to 70 to 90 days? Because
Absolutely.
we are just acting as an NBFC, alternate to NBFC only for the construction material. And any builder would be happy to take the orders or to give the orders to you because you are asking for the payment for 5-6 months after 6 months.
Yeah. So first, it's important to understand how this industry works. Fundamentally, credit is a given in this. It's a layer that we have to offer. It's not a credit business. It's a layer on top of the business that we do. It is not like they enjoy a longer credit period. We don't offer a longer credit period to get business. In this business, about, let's say, a 100 to 120 day receivable cycle is actually considered normal. How you manage the entire cash flow is what we are working on. And when you look at the improvement that we have gotten from 120 days of net working capital to going down below 100, in this quarter about 97 days, and we are 100% committed and focused to getting this down to maybe about 85 to 90 days in the coming quarters, is when you will start seeing the real results. So it's not about being an NBFC. I mean, the returns that we generate with gross margins are about 15%, with EBITDA is about 9%. It's very uncharacteristic of any NBFC, to be honest. It's really about how we operate. This is something that we invest consciously to maintain the relationship, to get involved with the customers, to actually build a very robust supply backbone, and to offer end-to-end execution services. It's a different infrastructure that we build to actually help the construction industry, and we are not just operating as a company which offers credit to do business.
Because I was asking, because when you have to grow by 30-40%, then managing the working capital at those top line levels would be difficult for the company.
In fact, it all depends on how you manage, and that's why during the speech we wanted to address this head on, because we feel that this has been a key area of focus for all investors. In the early years, we used our own equity. We took traditional debt on books, and that's how we were funding the working capital, essentially how we were paying our vendors. Now that we have a larger equity base, we are making structural shifts in how we actually manage working capital. We are already in process of getting access to supply chain financing facilities. That is not traditional debt on our books. It helps us to increase our payable days without actually straining relationships with vendors when they get money on day one, which effectively reduces the gap between payable. And that's how we will get to a targeted number of maybe 85 to 90 days in the coming quarters. And when you actually look at this, an asset churn of about 4 in a year, and less pressure on liquidity and working capital is when you're able to grow at the number that we've just mentioned.
So you will be trying to increase the payable days also?
Yes, that's something that we will do through supply chain financing facilities, not by not paying them early, but by actually getting access to these facilities so they are paid on day one.
Okay. Thank you. That's all from my side.
Thank you.
Thank you. The next question is from the line of Shaurya Yadav from Pinpoint X Capital. Please go ahead.
Yeah. Sir, just a follow-up question. What is our operating cash flow in Q1 FY26?
Sorry, can you repeat that, please?
The operating cash flow in Q1.
In Q1, I mean, we did not deploy much of the cash that we had. So we raised about 500. We had about cash balance of about 300 crores as on June quarter. So wouldn't be right to, that's the cash balance that we had, technically net debt free. So that's how we were positioned.
Sir, I'm asking for the operating cash flow.
So we will have to really come back to you on this, and if you can leave your email, we will come back to you with this.
Okay, sir. And sir, second question, how much of our cash is stuck in previous steel business in terms of amount, if you can tell?
So first of all, I don't think there is anything stuck in the business. If you see, we have an ECL provision which we have made, which is close to 20 crores. So all our slow-moving debtors are around that range and included in the ECL portion. So cumulatively, we would have done close to 3,500 to 4,000 crores of business. Out of the 20 crores is what is a slow-moving, and not that it has been written off. These are provisions, and we are working to get these as well.
And sir, by how much time we can recover it?
Sorry to interrupt. May I request you to rejoin the queue?
Okay.
Thank you.
So Shaurya, just to answer your question, as I said, out of a 4,000 crore business, 20 crores is what is the slow moving. I genuinely don't have an answer when we will recover, but we will definitely try to recover some out of it. But these are already provided in the financials.
Thank you. The next question is from the line of Nirav Shah from GC Holdings. Please go ahead.
Hi, sir. Good afternoon. A few questions. Firstly, just continuing with the provisioning number, I mean, if I look at the cumulative last 5 quarters of that provisioning that we have done, it's a negative 2.5 crore. So incrementally, we have not provided anything in the last 5 quarters, and maybe some margin support has come from there also, because that number is usually around 0.5%. So any particular reason why this loss allowance on receivable is for the last 5-6 quarters, it's a cumulative negative number?
So there was, when we had initially provided, there were certain provisions that we had made. We actually collected those back, and that was the reason why there was a negative one, which was, I think, primarily last Q1 2024, around 2 crores or something.
Yeah.
Now, if you look at the last 12 months run-up of our debtors as well, we are actually running a gross debtors of around 90 days. So we also learned from our past, and that was the reason why there was no need for any provisioning. We have a particular model on which the provisioning is made along with the auditors, and there was no need to provide anything, and that's good for us.
So we are making in some provisioning this year, financial year, entire year, which should be in the region of 0.5% or not needed?
No, I don't think so. So in our projections, we have kept a provision for 0.5%. Okay. However, on actual need base only we will do that. So all our guidance that we give, we are giving it after assuming that there would be a 0.5% of provisioning. But that doesn't mean that we will mandatorily provide that 0.5%. That would be based on the actual business that we do.
Got it. And sir, this exceptional number of 2.9 crores in this quarter, so now that entire IPO related expenditure is now provided for, now Q2 will not see any exceptional?
No, we will not see any of those exceptional coming out of IPO at least.
Okay. And lastly, I mean, what's the gross debt and net debt number, net cash number? Gross debt and gross cash, if you can provide that.
Gross debt as of now will be
113 crores.
Is around 113 crores, and we have cash in bank of around 300 crores.
377 crores.
Yeah.
Yes.
That's cash. Got it.
Yeah.
Sir, got it. Thanks, sir.
Thank you. The next question is from the line of Vishwender Singh from Prudent Equity. Please go ahead.
Hi, sir. I wanted to ask, the Q1 tax rate was around 19%. So what will be your effective tax rate for the full year?
What is the question?
Sorry, I couldn't understand the question.
Can you repeat, sir?
In Q1, sir, our tax rate was somewhere around 18 to 19%. So do you see this same going forward, or do we go back to 25% tax rate?
I think projecting the tax number is not in my hands. We would assume if for the guidance reasons and for projections reason, you should take a safe 25% as the number.
Okay. Okay.
Yeah.
Thank you, sir.
Thank you. The next question is from the line of Parth Chauhan from Patel Investment. Please go ahead.
Hello. Am I
Yes,
audible,
please
sir?
go on. Yes, you are.
Yeah. Sir, thank you for the opportunity. I just had a couple of questions. First one is that we are majorly focused in 3 or 4 geographies. So moving forward, what kind of strategies or steps are we taking to increase it to more tier 2 and tier 3s as well?
In terms of geography, as explained earlier in our previous call also, it's not a very conscious strategy where we want to spread across India in terms of tier 2, tier 3 cities. It's really about the kind of infrastructure or construction activity happening across India, and mainly in metro cities where we are present, where we have a very strong and a robust supply network. Even an annualized number of, let's say, 1,000 to 1,200 crore of revenue, we've still barely scratched the surface. So it's really not about spreading across India. It's really about capitalizing in the areas that we are currently present, and mainly concentrating on metro cities, which actually offer much more potential in terms of growth and margins as well.
Makes sense. It will be the logistics will be better in tier 1 cities as well compared to the other ones.
Yes. I mean, our backbone is our supply network. It's not like, selling materials in retail quantities. It's about the supply network that we have, and the stronger the supply network, the more we are able to fulfill and generate more returns. So that's something that we will look to concentrate on.
Got it. And the second question is on the financial side. So we turned profitable recently. I just wanted to know, moving forward, after stabilizing, what would be the EBITDA margin and the PAT margin that we would like to consider sustainable on a long period of time?
So, as explained earlier, Q1 numbers give a fair idea of where we are headed. In terms of the PAT, the recorded PAT was 5.1 crore after absorbing a 2.5 crore of IPO expense. At an annualized rate, that's about 30 plus crore without any IPO proceeds being used. And obviously, with the debt repaid, there will be more EBITDA flowing into the PAT. So the guidance of maybe 4 to about 6% PAT is, I think, fair enough as of now. We don't want to project very aggressive numbers. And in terms of EBITDA, I think we've recorded our highest ever EBITDA this quarter, which is just over about 9%. We will look to sustain that number as we grow, and if we are able to do that, I think we'll be generating substantial returns in terms of for our shareholders.
Got it. So 9% and 4% would be good numbers to calculate for the projections.
Pretty much there. Hard to give you exact hardcore numbers.
Sure. Good. That will work for now. I'll get in touch with the team if I need any more help for the projections.
Sure.
That is all from my side. Thank you so much, sir, and all the best.
Thank you.
Thank you. Ladies and gentlemen, this was the last question for the day. I now hand the conference over to Mr. Srinivasan Gopalan for the closing comments. Thank you, and over to you, sir.
Thank you, all of you. Thank you once again for joining us today. We are extremely pleased with the progress that we have made this quarter, reflecting in our highest ever EBITDA margin, improved profitability, and strong order book momentum. This performance underscores the strength of our integrated model and disciplined execution. Looking ahead, we remain committed to capital efficient growth, deepening our developer partnerships, and driving long-term value for all stakeholders. We appreciate your continued trust and support. We are a young company. We need your support over a long period of time. Thank you from all of us.
Thank you. On behalf of ArisInfra Solutions Limited, we conclude this conference. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.